In this video, we'll consider loss limits. Now, this is one of my favorite topics because you get to see the interaction of how these rules actually play out with one another. Basically, think of it like a big puzzle. We've been learning about tax rules, each piece of the puzzle. Once you get to various provisions later on, specifically when you're talking about property transactions, you get to see how the interaction of these provisions work, which completes the big piece of the tax puzzle. Before we go into the specifics, I want to mention that the Tax Cuts and Jobs Act has really added an additional element. This is really what you see here on the screen is really the historical framework of losses, starting with Section 1001, going all the way through the at-risk, passive activity, capital loss limits. We have some special rules, the 165 general hurdles, and all that still applies. But the Tax Cuts and Jobs Act of 2017 really added one additional item. And, there are some specific items on here that aren't specifically talked about, but the Tax Cuts and Jobs Act of 2017 did add one thing, and that is business losses from businesses other than C corporations. If you're the owner of a business and you have a loss for a year, then you're only allowed to take a deduction up to a certain amount. The excess business loss is suspended and carried forward into the future using the NOL rules. So excess business losses are limited or restricted, okay, and they're carried forward. You carry them forward like an NOL. Now, an excess business loss is a loss that is in excess of $500,000, an amount of $500,000 if you're married filing joint, or $250,000 for all other taxpayers. So really, you can only take up to a loss up to from a business activity of $500,000 if you're married filing joint from this business loss, $250,000 if you're another type of taxpayer. And that's really important because whatever is left over from that business loss, if you have $3 million, you can only take $500,000 if you're married filing joint, and then the $2.5 million gets carried over to the next year under the NOL rules. Now you can offset that against business income, but that's really important to understand because it can be restricted. So with that, let's go ahead and go through the framework. Now, in order to get into the limits, we have to start with how exactly do we have a loss? Section 1001, the Section 1001 framework, this is the gateway provision that says that in order to have a realized gain or loss, there must be a sale, or other disposition, which I'll mention the definition of those in a moment. A sale or other disposition, and if there is a sale or other disposition, the amount realized minus the adjusted basis gives us the realized gain if it's positive and the realized loss if it's negative. Now, a few things I want to focus in on. How do we know whether we have a sale or other disposition? Well, the regs actually say that a sale is a conversion of property for cash, and an other disposition is property for property. Now, the key, and there's a case, U.S. Supreme Court case called Cottage Savings, that says we have to look at materially distinct pieces of property. And in that case, there was actually different mortgages, or at least the court held that the mortgages were considered different, even though they were the same amounts, they had similar interest rates and whatnot, and there was a swap. But the court said, okay, when we actually look deep into it, the mortgages are on different properties which have different risk structures. Even though, again, it was the same amount, had the same interest rate, same term of the loan, all of those things were the same. Again, there's different risk structure. So if there's materially distinct components that the property is being traded for, it's considered another disposition. If it's similar, then you don't have an other disposition. It's not a taxable event. So amount realized minus adjusted basis gives us realized gain or loss. Now, the reason it's called realized gain or loss, if you recall back to the beginning, the first concept talked about the definition of gross income, there must be three criteria met under the Glenshaw-Glass decision to determine whether something is considered gross income. Must have an accession to wealth, clearly realized, and dominion and control. The realization element is what distinguishes certain transactions, certain events, certain economic events from being realized with respect to gains or losses. So what I'm referring to here is, let's say you own stock in a very profitable corporation. You buy the stock for $50 a share. A year later, the stock goes up in value up to $60 a share. The value of the stock going up doesn't create a realization event. Yes, economically, you now have more value. However, a realization event is what triggers that item, which allows for gain. The same with loss. And that's the same here. That's why we're calling this realized gain or loss. Now, amount realized and adjusted basis are themselves determined under the tax law, and that is not going to be discussed in this video. That will be discussed in another video. So if we do have a realized loss, which let's say is recognized, there's no non-recognition provisions that prevent that. So we have a recognized loss. So our realized loss will actually be recognized, which again, this will be in another topic, but realized versus recognized. Recognized is what goes on the tax return. Realized is just, again, the triggering event. So recognized is the key. If the realized loss becomes recognized, which means it very likely will be on the tax return, then we have to consider these loss limits. So we start by determining the loss, and then we actually have to now consider certain limitations on the losses. So the first stop on whether the recognized loss can be deducted. That's the key. We're asking, can we actually take this loss on a tax return as a benefit? Now, we first have to stop at section 165, which is the general loss deductibility rules. Under section 165, there's really three categories of activities, and based on those three activities is a general rule of whether a loss can be deducted. So the three are business, investment, and personal. The general rule is that business and investment losses can be deducted, but personal cannot unless there's some provision in the Internal Revenue Code that allows it. So for example, within section 165H, there's rules that allow for personal casualty theft losses. So casualty being a certain event is triggered, such as a hurricane or some destructive force comes and destroys, or even condemnation by a state. Theft, obviously, is when there's actual theft event. But for business and investment, again, the general rule is a loss can be taken. Now, we go through that section 165 criteria, the big three as I call it, the business, investment, personal. If the loss is allowed, and allowed is the key word, allowed versus disallowed. So remember that with regard to deductions, we're talking about allow versus disallow. That's the key language. So allow means it actually can go on the return. Disallow means it will not be allowed on the return. So once we consider the general loss provision, we then have to consider special loss limitation rules. And some examples of these include Section 267 related party rules and Section 1099 wash sales. So related parties, if there's a loss that happens with this Section 1001 realized and recognized loss, if there is a loss that results in, let's say, a sale or an exchange, and it's between certain related parties, which consider that discussion from a previous topic, then the loss will not be allowed. It will be disallowed. Now, it's possible that the loss might be suspended and be able to be taken in the future based on certain criteria. Again, see that discussion, a previous topic. Section 1091 deals with wash sales, which is when you purchase a security, then you sell it, and then you purchase it again within a certain period of time. And the idea is that there was abuse. Certain people were trying to utilize losses, then rebuy the securities, and that way they could take the loss a certain year, even though the value of the property went down, so they could offset their income. So that's what wash sales have to do with, Section 1091. And there's other special loss limitation rules, but those are some of the major ones. So once we get past the general loss limitations and the special loss limitations, we then have to consider two provisions that are generally thought of to stop what we call tax shelters. Oh, you probably heard of these, this phrase tax shelter. It's a scary term, right? We always hear about it. How maybe a company puts its money offshore in the Cayman Islands or some country so that they can get some type of benefit, avoid taxes, a tax shelter. right? Whether it's illegal or legal. Well, these provisions were put in the law, the at-risk limitations and the passive activity loss limits, so that the tax shelters that were happening would be stopped. Now, really what was happening is you'd have professionals or you'd have taxpayers that had lots of ordinary income, which ordinary income is taxed at generally thought of higher rates than capital gains, those kind of things. So they had lots and lots of ordinary income. For example, a physician. A physician working as an employee of a hospital might make $1 million a year, $500,000 a year. Maybe they're a surgeon, a physician, a surgeon, whatnot. Well, that's all ordinary income. And it could be taxed at a very high rate. At one time in our U.S. history, there was a 96% rate on ordinary income. Capital gains historically have been about 28%, historically. So imagine 96%, but you could get that tax rate down to 28%. Well, that's a huge deal. So one thing is that you could try to disguise your income as capital gain. Another thing is that you could use certain types of tax shelters that were developed using various business entity vehicles where, for example, a limited partnership, where the physician would invest in a certain limited partnership. The physician would be allocated certain losses that would offset the physician's ordinary income and get the ordinary income rate down from, let's say, 60-70% rate down to a more manageable 30-40%. That's what tax shelters dealt with. The physician would be allocated certain losses, and they would invest in this limited partnership just to get tax benefits that would lower their tax rate, because our tax system is a progressive structure, so there's different rates. The higher rate, the more money you have. So Section 465 is the first hurdle you have to go through, the at-risk limits. And by the way, when you're going through these hurdles, if you are stopped by any hurdle, you must stop. You don't go. So the idea is that you keep going until you get down to the end, which is the loss deduction allowed on the tax return. So here, the first of these tax shelter anti-abuse rules is the at-risk limits. And what the at-risk limit rules deal with is a lot of the tax shelter entity limited partnerships I was referring to, they dealt with mortgages, specifically non-recourse. Recourse versus non-recourse. Recourse financing, somebody is personally liable for the debt, or the entity is personally liable for the debt, which means the owners will be liable. A non-recourse, neither the entity nor the owners, no one is specifically liable with respect to that debt. And what I mean by liable, you can't go after your personal assets. So recourse liability, you can go after the personal assets. Non-recourse, you can't. You're limited to the investment. Think of it like if you've ever learned about the business entities, you have a sole proprietorship, corporation, general partnership, limited liability company, and certain entities, the owners are limited with respect to their investments. Others, the owner could be sued potentially for, even beyond their investment, their personal assets. Well, that's the same idea here. With the non-recourse liability, you can only go after the investment. Recourse, though, you have more skin in the game, which means you can go after personal assets with respect to a certain amount. So the at-risk limits allow a loss deduction with respect to the amount that the taxpayer is considered at risk. I mean, they actually have the skin in the game with respect to the deductions that are being taken. Because again, the idea is that depreciation was generally how the losses were being taken. Depreciation deductions. So these depreciation deductions, which the general tax shelter would invest in a building through non-recourse financing, and the owners would be allocated losses or depreciation a certain way. And again, the physician that buys into it, he or she might be allocated more than maybe some of the other partners or owners of the entity. And the at-risk limits, they come in and say, no, you can only deduct with respect to the amount you're at risk. So in a certain year, if you're not allowed to deduct with respect to the at-risk amount, then it gets suspended. So with respect to these two rules, you can have a suspended loss, which means you can take it in a future year. So contrast that with the Section 165 general loss rules. If you have a personal loss and there's no provision in the code that allows it, you're never going to be able to take that loss. But with some of these other rules, You can have suspended losses. Suspended meaning you might be able to take it in the future, which timing is huge. Remember that we always talk about one of our themes is time value of money. It's better to take a loss today. For losses or deductions, we want today rather than tomorrow. Keeping into account that tax rates won't change, all that good stuff. But for income, we want to accelerate because of time value of money. A dollar is worth more today than in the future. So that's the at-risk limits. If you've determined that the amount is at risk, then you continue to the passive activity loss limits. So the passive activity loss limits are even further limitation with respect to these tax shelters, and what this one basically killed it off. So the at-risk ones, they really damaged these tax shelters. The passive activity loss limitations, this one killed it. So if you didn't get hit with the at-risk, usually you got hit with the passive activity loss with respect to tax shelters. So passive activity loss limits, really what they do is they break activities into 3 different categories. So I know this is getting tough, right? We had 3 categories here with respect to Section 165, but then we have these 3 categories, or a better way to think about them, they call them categories, but I call them baskets. There's 3 baskets with respect to the passive activity loss limits. So the 3 baskets, first we have active. So we have active. Next we have passive. And finally we have what's called portfolio. And the idea is that based on certain activities taxpayers have, you can only take losses within each basket on the income that's earned off that. That's the general rule. There's a few exceptions to that if you're in real estate and whatnot, but that's the general rule. You can only use losses with gains in the basket. You can only use losses and gains within each basket. So active means that you are a material participant within the activity. So the idea here is if you're a limited partner, a silent partner, and all you're doing is you're just putting money up, with respect to the partnership, and you're not actually dealing with the day-to-day operations, you're considered a passive owner. But if you are actively managing the business on a day-to-day, and there's different tests, different bright line rules out there, you're active. And any active income you have, which if you're a physician, right, you're active with respect to your practice because you're actually doing the work, you can offset your active losses with your active income. But passive losses, so the physician, for example, can't offset his or her passive losses from the limited partnership that he or she had no activity, no actual, material participation activity with the physician active income. You can't do that. Portfolio is your income and losses with respect to portfolio activities such as bonds, stock, interest, dividends within the item. So there'll be more discussion of these items, the at-risk limits and the passive activity loss limits later on, but I just want to give you a general overview. So once you go through Section 465 and 469, this applies to all losses. You then have to consider capital loss limits. So characterization will be a topic for a later discussion, but just note that if you have a capital loss instead of an ordinary loss, it might be limited severely, even based on the entity you are, against capital gains. And if you're individual, you might be able to use it against some ordinary income, but probably not much of it. But you can only use capital losses with respect to capital gains, ordinary losses with respect to ordinary income. So we generally prefer to have ordinary losses because the physician wants to get at that 60-70% tax rate. So if it's capital loss, then it's not going to be allowed to be offset, generally speaking. Finally, if you get through all of this, if you get through the Section 165, you get through the special loss limitations, you get through the Section 465 at-risk limitations, you get through the Section 469 passive activity loss limits, you get through capital loss limits, finally, you've made it free. You can deduct it on your tax return. Now, you might have limited some amounts along the way, which remember, it might be suspended. So you might be able to use it in a future year. So it's not an all or nothing approach. Some rules it is, especially here in the general loss limits, it is all or nothing. Example, if it's a personal loss, you sell your home for a loss. If it's a personal home, I'm telling you right now, there's no provision that allows that you can take that loss in your tax return. That's for your personal house. Personal gains on your house are special rules that might allow you to exclude gain. But personal loss you can't take because, again, the 3 categories, the big 3 as I call them, the big 3, they don't allow you to take personal losses unless there's some provision that allows for that loss, like the the casualty and theft losses. So if you go through all this, you might have some limit, you might limited and not allowed, you might have some suspended, and you might have some that is taken on the tax return in the current year. So this really concludes this topic. Again, there will be some other videos that will go into more detail with respect to some of these rules.